So we're finishing up ratios today. We're just going through and reviewing the last couple that we went over on Wednesday or Monday, I guess. So earnings per share. Does this mean, let's just go and verify this, does that mean that that was the dividends that the common shareholders got? No.
It's what the actual value of each share is.
No, it's not the value. The value is what it's trading for on the stock exchange.
That's how much you're bringing in earnings for each share of stock.
Right, but does that mean that's how much I get?
No.
No, it's just the potential net income that's generated by each share of stock. In and of itself, in my opinion, probably stock analysts would disagree because they know a whole bunch more than I do, but in my opinion, earnings per share isn't as critical as the next ratio that Monica uses, that market price divided by earnings per share. That shows, based upon how much income is generated by each share of stock, how is the stock priced? And the thing that's so critical about this is in so many of these high-tech startup companies, they really don't have any earnings, do they? It's all built on hype. Future ads, future app users, future development. So their EPS is going to be super low or almost non-existent, and they've got these really high market prices. So what was this over here, this about 15? What was I talking about there? That's about the average PE ratio over time in the stock market over the last, if you ran stats over the last, whatever, I don't know, I'm just making this up, but let's say 100 years, it flushes out to about 12 to 15 times. So what's wrong with it? What's happening in the market when that number's up closer to 20 like it is now? The market's overpriced, right? Potentially. Or it's got a lot of these companies that don't have any earnings, but tons of hype.
Can you say that one statement? It's the PE ratio, how is the price
Compared to the earnings potential. What's going on? Sorry, I'm struggling with this today. Did I get a new file or what happened? Okay, so we're just finishing market performance. We've got a couple more to do. So we did EPS, we did PE ratio. We saw that our company that we're looking at had a PE ratio of 12.5 times. Now we're going to do the dividend payout ratio. And this is a ratio essentially that tells us what percentage of those earnings are paid out in dividends. What percentage of the earnings are paid out in dividends? And we just ascertained that EPS isn't really the payout, is it? It's just the earnings potential. So that's great. I want to know what that is, but really what I'm interested in as a shareholder is show me the money, right? What percentage is being paid out? So the calculation for that is dividend per share. Divided by earnings per share. It's going to be a percentage. Yep. So you've got all that information. Why don't you calculate that? And And we'll move on to the last one, and then we'll go through our homework. Hi. Oh. Oh. Yeah. Oh. Yeah. And that's gonna go right into the storm drain.
Yeah, I just need to go
I've got a neighbor that I watch pour oil in trees on North Gravel Road. And the dude, the aquifer is like 10 feet below that. He's in 2 days. I mean, let's be honest, in this day and age, it's like, and it's not like retail, like, he sees me riding by on my bike, I'm sure he thinks I'm some bleeding heart liberal, which I am, but okay, he's not gonna listen to me. Okay, so I gave you the dividend per share, I think, in the additional notes, 80 cents. Okay, great. So they're paying me, actually physically paying me 80 cents a share, right? And how much is each share of stock generating in earnings? $49%. Can you explain that in layman's terms to somebody? Is that good? What's our standard answer when I ask you if something's good? It depends. You have to compare it. What was my percentage payout last year? What are equivalent risk companies paying them? Sure. Well, you should be. Sure. Yeah. You want it to go up. You want the percentage that they're returning to you. Well, okay, flip side is, what if that number was 100%? What would that tell you? I mean, they're paying out a ton, but if they're paying out all their income to their shareholders, they have nothing left to what? To reinvest in expansion and growth and strategic, maneuvering. So, got to be a balance. Yeah, you want to maximize that while retaining enough earnings for emergencies, downturns, and/or, expansion. Okay, final, I think. Oh, no, 2 more. Dividend yield. This is very similar to the payout ratio. A dividend yield is the dividends per share divided by the market price. This is also a percentage. So this is dividend per common share divided by market price. In other words, for what's it paying out in comparison to what it's trading for? Well, what it allows you to do is compare it to everything else you own. I have some real estate. I have some international bonds. I have some investment in your company. Based upon what my real estate's worth, my bonds trading for, my stocks trading for, what's my yield? Right, what was the dividend again, 80 cents? And how much is it trading for? $24.50. Where did we get what? So, and this is going to change every day because the market price is going to change every day, because when anything trades on the stock exchange, it basically changes on the microsecond, doesn't it? And lastly, book value. And book value is simply, it's really, I don't think it's a very meaningful ratio. All it is, it says based upon the par value of the stock on your books, what is each share's book value at? It has nothing, make sure you write in huge notes, letters in your notes. Book value has nothing to do with market value. Market value is a composite of all sorts of extraneous stuff, isn't it? It's just what each share of stock is on the books at. No, it's a dollar amount. So that's your equity divided by your number of shares. Number of common shares of stock outstanding. So you can calculate that for 2012, please, using Marleya. I'm sorry, this is common stockholders' equity. So you've got to pull out the par value of preferred. So let's go ahead, look at Marleya, grab their total equity number, and then pull out the amount that is allocable to the preferred shareholders' par value. So total equity was $829.5. What portion of that is attributable to your preferred shareholders? I thought I have 150. That's the dividends. And how many shares are outstanding of common stock? 50,000 shares, so this is dollars divided by so how much is my book value? How much? Everyone get that? $13.59. Go ahead. The 50,000 shares comes from, look at the par value of your common stock. What is the par value of your common stock? I'm sorry, 100,000. $500,000, right? Is what's in my account. And to find the number of shares, if you divide by par value, by the $10, that means there were 50,000 shares issued at $10 par. Did everybody catch that? It's basically just saying what portion of the total claim on the company's equity does each share of common stock have? I think it's just kind of irrelevant. I mean, what do you do with this? You know, like, so let's just put the number up. What's the number again? Thank you. Like, here's why I think it's irrelevant, or why I don't really know what to do with it. What do I do, for example, with this 3.9%? That's how much I'm getting for dividends based on what the stock's trading for. What do I do with that? Why is that important to me? Is that a good yield? I don't know. My savings account's getting 0.01%. It depends upon how risky this is. And you compare it to other like-kind risky companies and say, is it worth the risk? I mean, that's not a very high yield. But if it's super low risk, it's like, yeah, I don't mind earning 3.9% if I've got very low risk of losing my principal. You can never really be sure that stock's okay. So for, just this off the cuff, but for your average stock, I'm not willing to take the risk for 3.9%. I'm wanting 7 or 8 or 10% if I'm going to put my money in the stock market. But again, it depends. Is this an emerging world fund, or is this like an old blue dog fund like IBM or 3M or GE, right? So, I mean, there's just so many things that come into it, but you can compare it. This number's super helpful because at the end of the year, we always go through our personal stuff and our business stuff, and we calculate our yields on everything, and it makes you kind of weigh in at the end of every year, like, how did it perform? Do I want to keep it? How did it compare to other companies and benchmarks? And then this guy's super useful because what does that show you? Or what do you use that for? Yeah, and so I'm going to assess, what am I going to assess about the company based on that? Yeah, what's it look? Does it look like it's retaining, expanding, paying out? And if I'm on a fixed income and I'm 80 years old, am I interested in expansion or getting a dividend payout? If I'm my age, in my 50s, I've still got 10 years to retirement, I want to see him expanding and staying competitive and making money, right? So it depends upon where you are in your life. All right. Have we beat these up enough? Let's go ahead and take a look at the practice problems. Oh, I'm sorry, one more final thing. If you turn to oh, never mind, they don't have it here. They do have a good review problem on page 694. I think I told you about that for the final chapters. We're only doing 2 chapters, on the final, right, 14 and 15. The review problems are excellent in the book for both of those, but I will tell you, you need to work it as if you're in the test. In other words, what am I saying? Well, A, don't look at the answers, and B, you can't have the ratios sitting in front of you. I think we've gone over 4 ratios that you can have, so that's the cheat sheet you've got. So doing the review with all the ratios sitting in front of you is not helpful. Okay, so when you work the review problems, what I'm saying is spend time going over homework, going over your notes, feeling like, and then sit down and work the reviews as if they were the exam. Okay? Alrighty. So, 15-1 on page 698. What does that mean to common size your statements? Common size your financials. Yeah, so that you can look between a couple of years, or you can look against other companies that are different sizes, right? So am I going to do vertical or horizontal analysis to common size? Common sizing is the vertical, isn't it, where I take everything as a percentage of one number. On the balance sheet, what do I take everything as a percentage of? What's my pivotal number? No, balance sheet. You guys, balance sheet. Yeah. Yeah, your base is always, so your total assets equal liabilities plus equity, right? So it's everything is shown as a percentage of assets or liabilities and equity, which is the same number, right? So you're common sizing. So I can take a little local company that produces merino wool sweaters and compare it to Patagonia. What percentage was your gross profit? That's income statement. What percentage were your current assets? What percentage is your long-term debt? What percentage is your bonds payable? And then I can say, like, how do I compare? I can common size between a little company doing 200 grand a year and a company doing 250 million, right? So these guys, we've got 2 years. It says members of the company's board of directors are surprised to see the net income increased by only $38,000 when sales increased by $2 million. Express each year's income statement in common size percentages, carry the computations to one place, and then tell me what you see by looking at this. Jess, do you want to hit the lights? So they're concerned. The sales went up $2 million, but my income only went up $68,000. So I'm sitting here looking at percentages. What jumps out at you? Cost of goods went up fairly significantly, 4 percentage points almost. How's that going to impact the whole rest of your P&L? Right, because it does, because sales minus COGS is gross margin, so anytime COGS goes up, your gross margin goes down. Can somebody refresh all of us what gross margin is? It's not the same as contribution margin because this isn't split into variable and fixed, is it? Yeah, once you've covered the cost of your inventory, which is what you're in the business of doing, this is what I've got left to cover everything else and generate a profit. Companies, if you manage a company, you know your gross margin on a weekly basis. Okay, it's not relevant in a service agency, is it? But when you sell a thing, you know exactly. Here at the university, we know what it costs, even though we don't really have a COGS because we don't have inventory. We know what it costs to service a student. That's, in essence, your COGS, isn't it? So you know your gross margin. We know that our gross margin is really different between an in-state and out-of-state student, a part-time and a full-time student. So you're going to really dig into these numbers and understand the components of it in order to manage your business. But just looking at this on a cursory glance, I can see my COGS went up. As Jessica said, that drove my gross margin down. Anything else that you see that seems relevant, or is that pretty much the beginning and the end of what changed the net income? Admin went down significantly. What does that say to you? I've either had some attrition or a layoff, and I didn't replace, right? So, yeah, and basically what you, interest expense went down. Again, as a percentage of sales, we don't really know what happened to the actual dollars. So basically what happened here is that the cost of my inventory was up significantly, and the decrease in whatever my admin was, it wasn't enough to compensate for the increase in inventory.
There's other decreases in there too. But like with the interest expense, that all those decreases just don't.
They don't add up, do they, to the inventory increase or the cost of goods sold increase, which is the, could this be managed? I mean, we don't know what we're selling, so it's kind of an artificial question, but what would you do if this was your company? Are you concerned? Your sales went up, your income went up, what's the problem? I want to know specifically why my cost of goods sold went up. Now, in a period of very little inflation, which is what we're in now, extraordinarily low gas prices, which we're in now, and of course energy's embedded in everything, there should be a pretty compelling reason why your inventory went up that much, right? Like is there not enough supply of it, and or I mean, is your vendor playing with you? I mean, do you have to, I mean, you would just really have to dial in and figure out in a period of not much inflation why this happened. Okay. Yeah, it absolutely could be a book error. I mean, you would probably, okay, here, that's a really good point that Perry just had. First off, everything we do here, we're picking up a textbook and opening it up and seeing the numbers for the first time. If this was your company, do you know what's going on with your inventory costs on a daily basis? Of course you do. If you get to the end of the year and you run these numbers and it's like, my inventory costs didn't go up, that's the first thing. Is like, oh my gosh, I've made some sort of accounting error. I better dial in and pull my GL and my general ledger and look at a detail and find out what happened there. Good. Okay. Number 2. We're assessing liquidity. We have comparative financials for Weller Corp, a merchandising company, fiscal year ending 12/31. They didn't issue any new common stock. They have 800,000 shares outstanding. The interest rate on the bonds is 12%. Their income tax rate is 40%. And the dividends per share of common stock was 40 cents. And at the end of the year, their market value was $18. So they give us a pretty comprehensive balance sheet and P&L. And basically, they just want us to go in the next 3 problems through a series of calculations. So I'm just going to do these for you. Working capital 14,680, current ratio 2.4, acid test 1.31. What do these numbers show you? Melanie, can you tell me anything based on these numbers? Do you know that you brought in more assets? Tell me what that 2.4 is. For every, go to your denominator. So you can honestly explain any of these by saying for every $1 of current liability, I have $2.40 of current assets covered. Tirsa, what's the difference between the 2.4 and the 1.3? Which one's more meaningful, and why do we run both of them? Okay, can everybody hear Sherry? Because that was a great explanation. This one up here, okay, $14,680. That's just an actual cash number. That means today, snapshot point in time, I have 14 grand. If I were to liquidate everything, that's an important number to keep an eye on. But I mean, rarely do you need to do that, right? What's really important is your ability to pay your bills as they come due are in these two ratios. Your current ratio, also called your working capital ratio, or your acid test ratio, also called a what? Quick ratio. If you had to liquidate all of your current assets, which ones might you have trouble with just from a cursory glance? Equipment's not current. Land's not current. Inventory, you may or may not be able to. If you sell lettuce, you could probably liquidate it. If you sell, engine parts for sea-going ships, you're probably not going to be able to liquidate your inventory in a marine exchange, are you? So it totally depends on what kind of inventory you have. The other kind of current assets that really is not liquidatable are your prepaid expenses. So really, in your asset test ratio, that's saying my cash and cash equivalents. In other words, my marketable securities, my cash, and hopefully assuming that I can collect my AR in the short term. That may or may not be an accurate assumption either. What do we look at to determine what situation or what status our AR is in? What's the name of that report? You look at it to see how many days everyone's outstanding. Okay, it's not, it is, we are looking at average collection, but I'm talking about, I want to look at a list of everyone that owes me money. And are they current? Are they 30 or more days overdue? Are they 60 or more days overdue? It is, it's called an aging schedule, receivables aging schedule. And that's something else that you're pretty married to if you grant credit in the business. You've got to watch that because if people get out there too far, it's like the collectability goes down, doesn't it? So I can't really say, oh gosh, my AR's totally, no problem liquidating it if I've got an aging schedule full of 90-plus day accounts. Sure, absolutely. Now, the question is, can you sell your AR? I don't honestly know. Well, we do, yeah, of course we do. In Missoula, we have a company or organization called Collection Bureau Services. And I don't know if you employ them to collect your AR or if you sell your AR to them. Do you sell it to them and then you're just done?
Yeah.
Yep. Right. Well, sure. Yeah, sure. Yes. So, yeah, so that's what they do. I wasn't quite sure how they operated here. There's kind of two models, but it's called a discount rate, and I couldn't imagine doing this. I would shoot myself in the head if I had to do it for a living, but, you go and I go, you guys all have aging AR schedules, and I look at them, and I say, what percentage of each of the different classes do I think I'm going to collect? 120 plus days, you probably got about a 5% chance of collecting them. 30 to 60, I've got a 50% chance of collecting. And then I apply discount factors to it, and then I just offer you a price, and you say yay or nay. And then I take it back to my crib, and I try and get more money, and then I pay for it. Right? Not really a sustainable method of getting money out of people. If I'm broke, threatening me with bad credit is like, how helpful is that? A, I probably already got that credit. B, I mean, if I'm living on $900 a month, I mean, you can't bleed a stone. But if you tell me you can pay me $10 a month, and I know because I've been there. We've been in this situation years ago a couple of times. I'll pay you $10 a month forever, absolutely. You know, give me something that I can do, and I'll make it happen. Telling me I have to write you a check for $1,000 tomorrow is, you know, save your breath. Don't have it. Not going to get it.
And you have to wonder why they don't know it. It's because they don't
I don't know.
They're not sales.
Yeah, I don't know. Oh God, do they?
Yeah, I had to go and
Oh. Eek. Oh, I mean, score. Okay, so let's go through these. These are our asset management. And between the first two, let's see, who am I on? Jake, what can you tell me about the AR turnover and the average collection period? What does this tell us about our company? 15-3. So the AR turnover is 7.4, and what should that say? 7.4 what? Times. And then the average collection period is about 49 days. What does that tell us? Not the whole cycle. Yeah, AR to cash. Oops. Yeah, and let's, I just want to correct this because I'm glad you brought that up. Maybe not. I'm going to just erase this. I don't want to mess with this. Yeah, just do it right here. What was our circle again, if you're in a retail organization? You start with money. You buy inventory. You sell it and convert it. Not all of it. Some of it you might have cash sales, but convert it hopefully to what? AR. So what we were just doing here, was that 50 days or 49 days? Is this piece of it, isn't it? The second set of ratios is our inventory turnover. How many times in a cycle do I convert my inventory? And it's about 63 days to do that. Let's see, so we're at my 63 days here. So if you add, and it's assuming cash to inventories, you know, I mean, it's assuming this, which it really isn't, but what do these two numbers together give you then? That's my what? Very good. That's my operating cycle. And obviously, the more you minimize this, the higher your net income is going to be. Of course, if you keep your selling expenses in line. Okay, good. Oh, here we go. And then lastly, in here they wanted to see the total asset turnover, which is what divided by what without looking? Sales or income? Sales. Average assets. How well do my assets do to generate sales? This is different from ROA, which is how well does my assets do to generate what? Whenever you see the word return, that means what? Income or dividends. So ROA is how well do my assets do in generating income? This is how well do my assets do in generating sales? How many times do I convert the book value of my assets into sales every operating cycle? Okay, and lastly, This is debt management ratios. What does that 10.8? That should be 10.8 what? 10.8 times, right? How many times does my net income, well, actually my EBIT, which that stands for what? Earnings before interest and taxes. How many times does my EBIT cover my interest? So that's not even saying that you can pay down the principal of your debt. That's just saying I can make my interest payments, right? Number 2, calculation of debt to equity ratio. What is that? 44 is 44 what? Right, so it's basically saying for every dollar of what? Other way around. Whenever you say that, you have to start with the denominator. For every $1 of equity, I've got about 44 cents of liability. And this tells you, gives you a snapshot of how you've capitalized your company. In other words, have I issued a lot of stock and retained a lot of earnings, or am I pretty debt heavy? And in different stages of a company's life, these numbers are going to look different, or should look different. Equity multiplier shows what? I don't really know what this shows. What does this show? Jess is looking at me with furrowed brow like, really? You don't know what it shows either? I don't know what I would use it for, I guess. I know what it shows. I don't know what I would use it for. But it's not income. So what do I use that to manage? I don't like this. We're not going to worry about that one. I don't know what it does. No, I don't. I'll make sure. I just don't know what it shows. Sure, you can cross that one off. I just don't know what you would manage with that. Me neither. Scribble. 15.7 is our horizontal analysis. Whenever you see the word trend, that translates to horizontal, because that's across the row of data showing the change between periods. When you see the word common size, you know I mean what? Vertical. When you see trend, it means horizontal. This helps us look at the difference between years on whatever item it is I'm talking about. You know, I'm talking about my selling expenses or my AR or whatever. And so basically this tells us, well, you tell me what this tells us. Are we using year 1 as the base for all these? Yeah, okay.
And so your sales went up on a steady upgrade. There's no.
How do I feel about that?
That means you're growing.
Yeah, I mean, there's not really any fluctuations, are there? The only thing I would ever say about something like this, like you're like, how could this ever be bad? The only way that this could ever be bad, or not only way, I would want to make sure that my sales were diversified over a wide range of kinds of clients. Because in economic downturns, if you only have a really small client base, or like there's 3 customers in here, you're really exposed, aren't you? In a nonprofit, you have to be concerned about what? You're not selling things, but you're getting what? You're getting contributions, you're getting donations, you're getting grants, you're billing for services to clients perhaps.
So if your David County doesn't give salvation army,
Yes.
you get X amount of money from the
Yes.
salvation army from the county, $38,000. You have X amount of people in the county that need help with their rent. You have to determine what amount of what to give to each person.
Sure.
And whether the county is going to do it the same next year or the year after.
Well, and that's where the vulnerabilities happened, you guys, as our state and federal budgets have gotten crunched. a lot of those big grants are starting to dry up. Just, I'm sorry, let me just, yep, it's pretty tough. Liabilities, okay, cash, what do you see in the current assets? Got about 2 minutes left.
With the accounts receivable, that was 20%.
Yeah, what does that show? That shows my sales are increasing, but my AR is jumping. So what does that say to you? Tie those two concepts together. They're not paying me back as fast, but my sales are growing, my AR is growing much more. That says to me that I maybe have released or freed up my credit restrictions or guidelines, and I'm selling to people that really can't afford my product. That's one of the first things somebody will do, a manager will do, to get the numbers up, right? Like reduce restrictions on credit so they can sell more. Well, that's great. Your P&L looks fantastic. But this is not great at all. I'm selling stuff I can't get paid for. I'm not really sure what I benefited there. What else do you see here? Cash is going down because I'm not collecting my AR. So actually, this is probably a pretty scary situation. My current liabilities are jumping because I'm not getting cash in to pay my bills. Yeah, there's red flags everywhere here. And believe me, you wouldn't be waiting till year 5 to do this. Okay, you guys tell me what you want to do on Friday. Do you want to come and go over your